Today, I want to explain what the IMF is effectively warning about when it highlights South Korea's large stock of dollar assets exposed to currency risk, especially in relation to the size of the local foreign exchange market, and why that matters for Korea's economy in 2026. In the IMF's Global Financial Stability Report, the focus is not simply the won is weak, but something more structural. In countries where FX risk in dollar assets is large relative to local FX market depth, the need to hedge can become a macro financial amplifier. In other words, when uncertainty rises, many investors may try to hedge at the same time, and that synchronized behavior can push funding costs higher, widen bid-ask spreads, and increase exchange rate volatility beyond what fundamentals alone would suggest. Recent reporting around Korea translates that IMF framework into a concrete vulnerability. Korea's FX risk-exposed dollar assets have been described as roughly around 25 times the country's FX market transaction volume in the IMF's October 2025 assessment, placing Korea in the upper tier of economies where hedging flows can become too large relative to the local market. So how does that spill into the real economy? First, inflation and purchasing power. A weaker won raises the local currency cost of imported goods and energy, and it can keep inflation sticky even when global inflation is cooling. That matters for households, but it also matters for policy. If the currency is unstable, the central bank becomes more cautious about easing because rate cuts can widen interest rate differentials and invite renewed depreciation pressure. In fact, recent coverage has emphasized that currency concerns are constraining the Bank of Korea's policy room. One reason markets have expected the BOK to remain careful on further easing. Second, corporate finance and investment. Korea's economy is export-driven, so a weaker won can help price competitiveness in simple terms. But the trade-off is that many firms carry dollar-linked liabilities, import intermediate goods, or hedge their cash flows. If hedging costs rise, exactly the stress channel the IMF describes, then financing becomes more expensive, risk management becomes harder, and investment decisions can be delayed. Third, market volatility and capital flows. When the currency weakens and volatility rises, foreign investors may demand a higher risk premium for Korean assets. Some local reporting has described a feedback loop. Foreign selling contributes to won weakness, which then triggers more dollar demand and defensive positioning, which can prolong volatility. Fourth, the overseas investment channel, especially large institutional investors. When domestic investors and institutions hold large overseas portfolios, FX hedging and rebalancing can become economically meaningful, not just portfolio-level decisions. Reuters coverage in early January captured how Korean officials were focused on stabilizing FX markets, repeatedly signaling that they would respond to volatility and disorderly moves. And the international dimension matters too. A notable Reuters report quoted U.S. Treasury Secretary Scott Bessent saying the won's depreciation was not aligned with fundamentals, and Korean officials stressing efforts to address FX volatility and dollar imbalance. Even without reading too much into a single remark, it shows that Korea's currency path is being watched at the policy level, because FX instability can spill into trade, inflation, and financial stability. So what is the key investor insight? The IMF's point is not that Korea is doomed to currency stress. The message is that in a world of recurring uncertainty, geopolitical risk, shifting rate expectations, and periodic risk-off waves, countries with large FX risky dollar asset positions relative to their local FX market can face episodes where hedging itself becomes a shock. When everyone hedges at once, the market's capacity matters. For Korea, that means three practical conclusions. 1. FX volatility can keep monetary policy tighter than growth alone would justify, which affects equities, real estate, and credit conditions. 2. Export strength from a weaker yuan may be partially offset by higher input costs and hedging expenses, so the net benefit depends on sector and balance sheet structure. 3. Watch policy signals and market plumbing, not just headline growth. In this environment, fundamentals and flow dynamics can diverge for meaningful stretches, and the IMF's framework is basically telling us to respect that gap. This is not a prediction. It is a way to understand why Korea's exchange rate can influence inflation, rates, corporate margins, and market stability, and why, in 2026, currency risk is not just a chart, but a macro driver.